Duolingo absolutely crushed its Q2 2026 earnings. I mean, they blew past Wall Street's profitability estimates, they added millions of new daily active users, and they even raised their full-year margin guidance. By every traditional metric, this was a blowout quarter. So, why did the market immediately punish them with a brutal 16.5% sell-off? That is the core mystery we are unraveling today.
The contrast here is just jarring. GAAP earnings per share came in at 66 cents, comfortably beating the consensus estimate of 58 cents. Daily active users surged by 23%. But despite all that, the stock plunged, trading way down into the low 120s. Today, we're going to look under the hood to see exactly what Wall Street is missing, why management is deliberately sacrificing short-term numbers, and why this exact moment might actually represent one of the most asymmetric risk-reward setups in the market right now. Let's dive right into this explainer. Part 1. The mechanics inside Duolingo's engine. Now, before we can really understand the market's panic, we have to understand exactly how this digital-first, habit-forming machine actually makes its money, right? It is not just a cute green owl. It's a highly sophisticated monetization funnel operating on a freemium architecture. Over 84% of their trailing 12-month revenue, which, by the way, sits at a massive $1.1 billion, comes directly from highly predictable premium subscriptions. We're talking Super Duolingo and Duolingo Max. The rest? It's a mix of ads served to free users, the Duolingo English proficiency test, and in-app purchases. They give the core product away for free, they get you addicted to learning, and then seamlessly transition the absolute most dedicated users into recurring revenue. But how do they get people so addicted in the first place? Well, it goes way beyond those famously aggressive push notifications from a slightly passive-aggressive digital bird. It actually builds into their ultimate competitive moat, the scale data flywheel. With 58.7 million daily active users executing hundreds of millions of exercises every single day, Duolingo collects a dataset of cognitive patterns that literally no competitor can match. They use an internal automated A/B testing framework called the Green Machine to endlessly optimize the user interface. The result of all that? A current user retention rate sitting at an all-time high of 84%. The psychology behind that kind of retention is what we call cognitive switching costs. Duolingo gamifies learning with leagues, interactive characters, and most importantly, the daily streak mechanic. Think about it. When a user has a 500-day or 1,000-day streak, the psychological resistance to abandoning that progress just to try a competing app is immense. That streak basically locks users into the ecosystem. And the pool of potential users they can pull into this ecosystem is just staggering. The total addressable market for global language learning software was roughly $14.2 billion in 2025, and it's projected to scale up to $38.6 billion by 2034. That's an 11.7% compound annual growth rate. With 1.8 billion active language learners globally, Duolingo's current $1.1 billion revenue footprint has barely even scratched the surface. Part 2. The central conflict. The misunderstood pivot. So if the market is huge, the moat is deep, and the earnings were a massive beat, where is the conflict? Well, the answer is that Wall Street hates uncertainty, and they especially hate it when a company stops optimizing for the current quarter. Management made a deliberate strategic pivot for 2026. They are intentionally prioritizing free user growth and product quality over near-term financial optimization. They are choosing to build an impenetrable moat of 100 million daily active users rather than squeezing every last cent out of their current base right now. They're doing this as a calculated defense against emerging AI startups that might try to commoditize language learning. And hey, just a quick aside, if this kind of research-first analysis is your thing, you'll probably want to subscribe. The really crucial point here is that this pivot is already working operationally. Just look at the concrete evidence from the Q2 announcement on August 5th, 2026. Revenue grew 18.3% to over $298 million. That daily active user search was critical, jumping 23% to 58.7 million, which is actually an acceleration from the previous quarter. And yes, while GAAP EPS of 66 cents was technically down from the record 91 cents in the prior year because of planned operational spending, it still comfortably beat analyst expectations. What's more, management is actually becoming more profitable underneath the hood. They raised their full-year adjusted EBITDA margin guidance to 26.5%. How'd they pull that off? Because they have successfully slashed their AI voice processing and cloud computation costs. By transitioning intensive generative AI tasks to highly optimized open-source models, they've driven the cost of conversational voice processing down to less than 1 single cent per call. That is massive. But here is the exact reason Wall Street panicked. Despite the DAU record and the margin hike, Duolingo issued Q3 revenue guidance of $302 million. Analysts were expecting $303.9 million. That slight guidance miss of less than $2 million completely overshadowed a fundamentally stellar quarter. The market saw a deceleration in short-term bookings, hit the panic button, and sold off, fearing that this intense focus on free users is permanently delaying cash monetization.
Part 3. Business Quality Scorecard. To see if this market reaction was a total overreaction, we need to step back from the quarterly noise. This scorecard cuts right through it. Financial health is a perfect 10 out of 10. The company carries absolutely zero long-term debt and sits on a massive $1.3 billion cushion of cash and short-term investments. Management gets a 9 out of 10, with founders Louis von Ahn and Severin Hacker maintaining solid Class B voting control. That ensures their long-term vision isn't derailed by short-term market tantrums. And with over 84% of revenue coming from predictable SaaS subscriptions, revenue quality sits at a 9 out of 10. That gives us a highly compelling blended overall score of 8.3 out of 10. Make no mistake, this is a fortress balance sheet. All of the research behind this explainer was created using Flash by StockSentinel.ai. You can generate deep research reports like this one for any public company in the world completely free at flash.stocksentinel.ai. The core company research is free. If you want an ongoing investing edge, Flash has a premium feature called Best Ideas Now. Every week, it surfaces the highest conviction ideas across 3 investor styles: long-term compounders, hidden gems, and dividend hunters. You also get Portfolio Watch, which monitors your portfolio and flags important changes, and Insider IQ, which tracks meaningful insider buying activity worldwide. You'll see a QR code in the bottom right. Scan it to download the Flash app and try it yourself, or access Flash on the web at flash.stocksentinel.ai. Pricing is going up over time, but once you lock in your subscription, your price never increases. Part 4. 5-Year Valuation Framework. Before we dive in, I need to clearly state that this is a hypothetical framework for thinking about possible outcomes. It is not a prediction, and it is not financial advice. The stock could go much higher or much lower than any of these scenarios. Okay, so we ran 3 scenarios projecting out to fiscal year 2031 from the post-earnings share price of $122.58. The base case carries a 55% probability, yielding a year 5 implied price of $333.53. The high case, driven by successful monetization of new subjects like math and music, yields $587.13. Even the low case, where user conversion slows down due to competitive pressure, still sees the stock marginally higher at $146.79. And just a reminder, if you want to access the full model with all the detailed assumptions for each scenario, you can check out the detailed research report at flash.stocksentinel.ai. Let's drill into the actual mechanics of that base case. For this to play out operationally, Duolingo needs to hit its target of 100 million daily active users by 2028. It assumes an 18% compound annual sales growth rate over 5 years, reaching over $2.7 billion in revenue. Crucially, it also assumes the successful rollout of direct web checkouts, which would allow Duolingo to bypass those 15 to 30% App Store commission fees charged by Apple and Google. That would massively expand their net margins. Under this specific scenario, we apply a reasonable 6.0x enterprise value to sales multiple. So when you apply the probability weights to all 3 scenarios, the base, high, and low, you arrive at a probability-weighted target of $359.58. Compared to a current price in the low 120s, this illustrates an incredibly attractive asymmetric risk-reward profile over a 5-year horizon. The downside is structurally limited by that massive cash pile and zero debt, while the upside is absolutely explosive if that 100 million user moat strategy actually pays off. Part 5. Thesis, Threats, and Risks. But look, investing is never a straight line, and we have to respect the bear case. The risks to this thesis really fall into 2 main buckets. First, we have internal execution risk. The whole premise of management's pivot relies on pulling in free users today and converting them tomorrow. If those free learners fail to convert to paid tiers at historical rates, average revenue per user could compress permanently, leading to a structural deceleration. Then you have external competitive risk. The rapid advancement of open-source conversational AI means lean, AI-native startups, like Speak, for example, could launch interactive voice coaching applications that completely undercut Duolingo's premium pricing, effectively commoditizing the product. So, what are the early warning signs you should be watching for in the coming quarters? Don't just watch the stock price. You need to watch the business mechanics. If paid subscriber penetration drops below 8.5%, that is a major red flag.
If subscription bookings growth decelerates below 8%, it signals that their core developed market consumer might actually be saturated. And finally, if core software gross margins compress below 68%, it means AI API licensing costs are starting to eat their lunch. These are your concrete early warning signals.
Part 6, the final verdict. Let's synthesize everything we've looked at today. We started with this mystery, right? A massive beat on earnings and users, yet a plunging stock price. The reality is that Duolingo is intentionally sacrificing a quarterly bookings beat to build an impenetrable 100 million user moat. Wall Street is impatient. They're punishing a slight guidance miss. But management is deliberately building a generational platform. The AI cost deflation tailwinds are very real, the balance sheet is bulletproof, and the massive scale data flywheel is pushing retention to all-time highs.
This market disconnect is precisely where long-term investors often find the most compelling opportunities. The question is, will you just be using Duolingo to learn your next language? Or is Wall Street's impatience giving you a generational entry point for your portfolio? If you want the full research, including the deeper framework behind this explainer, you can get it free at flash.stocksentinel.ai. Until next time, do your own research, and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.